Welcome everybody back to another episode of Investors Gallery. For those who haven't seen the episode before, I am in the so-called art gallery that I built in my home. The art gallery is on the other side of the room, and one day we'll actually film. And they were actually filmed in a live art gallery a couple months ago, and that was pretty cool. My name is Presley, and I am part of Dimensional Capital Partners here in Houston. We are a multifamily syndication development group and a group of investors as well. And I have another part of Dimensional Capital. Larry, do you even realize you're a part of Dimensional Capital?
You didn't even realize till you just said it right now.
Larry is one of our he's our financial side. So he's one of our partners that helps us do the CPA and all the numbers and stuff. So we kind of just bring him in on everything, whether he knows or not. So I'll let Larry introduce himself. He's been on more podcasts that I've probably done. So I'm really excited for this interview. Come on, Larry, bring us into your world and tell us what you do and how you got there.
No, I appreciate it. Larry Pendleton. I'm based out of Hampton Roads, Virginia, Norfolk to be exact. For those familiar with Southeastern Virginia. CPA by trade, been doing that for over 11 years now. It seems like longer. But started investing in real estate myself roughly 7 years ago at this point, and as with most investors, just kind of did the small single family rentals and just slowly kind of built up and kind of learned the better world of multifamily from that standpoint and just other investing opportunities. From there, just kind of saw the opportunity kind of merge the CPA world with the real estate world and just kind of focus PC Financials, which is the name of the tax firm, on solely serving other professionals in real estate. Our mission is to help as many people achieve financial freedom through real estate investing and tax planning. And we see that as a huge opportunity for a lot of people to make money in real estate as well as keep as much as they make as well. So yeah, it's been going great. Combine those two worlds and connected with Presley and others around the country, and looking forward to building from here.
So you started the CPA work. You said 11 years ago. What made you switch? Two questions. What made you switch over to real estate in that 7 year mark? And the bigger question is, what took you so long? Why did you wait? Was that 4 years, or do you think you should have took? Most people take longer.
Well, I think most, I guess a lot of accountants, I probably put myself in there, but we're rather risk adverse. I always knew the benefit of real estate when it came to taxes. I always recommended my clients to make sure they're investing into tangible assets such as real estate. But just kind of the limiting mindset that I have on myself on whether I can do it at that point. It was fortunate enough that my partner Terry Young Conyers, who's a Class A contractor over here as well, he's also a partner with the tax business. Just kind of he had too much on his plate at the time. He had this property that kind of fit to kind of ease me into it. So I was kind of fortunate to have that fall to my plate and still have that property today, cash flowing $400 a month. But I've actually had my lumps along the way with trying to do flips and all of that and not staying in my lane. So, so really, like I said, it just kind of, I mean, of course, everyone like credits Rich Dad Poor Dad and a whole
Yeah.
bunch of different books that I mean, the full gamut out there that a lot of people go through is like, okay, I'm just kind of climbing this ladder in this profession, but it may be up against the wrong building, where there's a bigger building I could have been climbing the whole time. So like I said, it was a good learning experience, but I was able to kind of sharpen my skills as a CPA and then now apply that skill set to real estate.
So when you got into real estate, it was through a single family
Yep.
rental. And how long ago did you transfer into multifamily?
Roughly in 2018,
Okay.
18 or 17, where the whole aspect of buying a rental property a year didn't really make sense. Like I said, I knew it will overall be a great play in the long run. It's just okay, the scalability, having the family. Like I said, I was building the business while having a W two at the same time. It was like, okay, I can't keep this up. So kind of came across Michael Blanc was actually my introduction into multifamilies. Saw some of his videos, then started kind of researching others in this space. And was like, okay, this actually makes more sense where I can kind of focus on what I'm good at, and then partner with others and what they're good at, and then we can all kind of come together and knock out some bigger deals or more deals along the way.
Cool. Yeah, man, you definitely have an advantage, I think, over a lot of other CPAs because you do this, but I'll let you kind of segue into that. So, um, for the first part, I want to just let everybody know, what you're doing in real estate and, obviously how you got into it and your thoughts. And then you can give us a whole bunch of free tax information at the end. So how many doors do you have now?
Roughly 57,
Okay.
including 2 plots of land.
Okay. What is your do you what is your or do you have a visionary number like 10,000 doors or 100,000 doors or 10 billion under asset? Do you have like a target that you're trying to obtain?
Not so much when it comes to the doors. I'm all about cash flow. You haven't seen my shirt that I'm wearing already. So if I,
I
like I
need one
said,
of those, by the way.
I gotta get you and Melvin one. Make sure everyone's suited up properly. But yeah, I'm more focused on like, hey, let's reach the next goal to get to 50,000 net cash flow per month. From that standpoint, there, and that's with real estate and the businesses as well, because they're going to be working side by side, and then slowly I'll start to phase out the tax business and just kind of focus on being a passive investor, and then we'll see what the next phase of scaling even more from 50 net cash flow to the next step from there.
So I can ask you this because you're actually the tax guy. I try to stay away from certain topics for those who are not the expert in those topics. Okay, so you say 50,000 net. Do you kind of look ahead and consider what probably minimal taxes you have to pay and depreciation, or how do you calculate what that net number is going to be?
Um, I factor. I don't really factor in the tax aspect of it because the way. Well, I guess I do because the goal is to pick up more and more passive income coming in because it's just taxed less harshly than running a business or having a W two or just or having being a flipper or a developer from that standpoint. So, because you're dealing with self-employment taxes on that spectrum of things. So like I'm balancing those two worlds now as being an investor and being a business owner. But the goal is to kind of use the the income and potential losses, the losses from the tax loss, I should say, from the rental real estate to help offset the income from the business. So the net income is just, hey, let's just compile all the activity together, and then slowly kind of like taking advantage of over these past 5 years with the bonus appreciation. Okay, can we maximize these opportunities? Then while aggressively scaling the business, and then use one to offset the other if when the opportunity arises.
Hmm. Um, what tax advantages? Oh, here's a big question that I try to answer, and I think I do a okay job answering it. But from an expert, what tax advantages do you have coming from a single family rental property versus a multifamily?
Mainly, it's just it's just a dollar play where it's like, okay, the larger the property, the larger um the deductions, the larger the depreciation that you'll claim as well. Now, you still have to factor in where, okay, single family may be you may have a couple of partners, whereas the larger multifamily, you're splitting that amongst uh three
Uh,
plus,
yeah,
maybe
a
five
lot more
partners,
people.
syndications. Like, there's a lot more people that you have uh to spread that around depending on how your deal is set up. So um the like I said, so it's advantage and a disadvantage because you could get bigger deductions, but how big of a pie do you got split at that point, where you may have a smaller property, um, and still get a decent deduction, but it's 100% yours, or maybe fifty
Hmm.
percent of it is yours there. So it's just kind of like just observing the numbers and making a deal that works for you. I just still prefer. I'm always going to be more of a side of a team player, whereas like I've done deals by myself, and it's real estate and life in general is more of a team sport. So
Yeah.
I don't mind spreading out the pie and then just rinse and repeat and just buy and acquire
Hmm.
more along the way.
Yeah, it's easier to take a headache when everybody gets a piece of that.
Yeah.
Do you do cost seg as well?
I do it in house for smaller properties,
Okay.
up to 6 units. If anything above that, I'm consulting or I'm bringing in Mass and Spec, CSSI, the typical names people are hearing across the country to help with larger properties, multifamily or commercial from that standpoint.
Okay. Um, what are in general? So this probably should have been the first question, but what in general are real estate tax advantages versus flipping will probably be the closest because I try to explain to people that when you're flipping, it's a business, it's not an investment. But just any type of ordinary business income, what's the difference of me doing this deal and I'm trying to make some money versus I'm investing in real estate? How are the tax liabilities and tax depreciation different in those two realms?
Well, from a taxification standpoint in general, like when you're talking about being a flipper or an agent or a broker or a wholesaler, that is more considered active or non-passive income, versus being a rental property owner, passive investor from that standpoint. Where if you're on the active side of things, if you, and you are making income, you could be hit with that additional 15.3% self-employment tax. Uh, People are typically W-2 employees are typically splitting that 50-50 with their employer, but as a self-employed individual, you are responsible for that full amount there. So you have to deal with that, and that's on top of whatever tax bracket that you fall in, or your effective tax rate there. So as I tell people, if like I say, if you're making $100,000 off of your flips or off of being an agent or a broker, your minimal tax bill is going to be somewhere around $15,000 because you got to deal with that self-employment tax. So all your deductions may not have a huge impact there. Um, Plus, when it comes to, and so another aspect where it's like unlike being a flipper, even though you own the property, because you're holding it for a short-term basis, the government considers that as inventory, so it's not a capital asset that can be depreciated. So you don't get the benefit of depreciation. And for those that don't know, it's just you're just the government allows you to recover the cost of like operating the building or deteriorating the building over a period of time. So you get that benefit on the rental property side of things. So one, you don't have to, and that income isn't subject to self-employment tax, and you get this additional paper expense called depreciation. So those are the two biggest benefits from a tax perspective when you're talking about the active side as a broker, agent, flipper, whatever, versus being a rental property owner.
How does Airbnb differ on the tax side?
So Airbnb is still considered a rental property, so it's the income itself is still considered the same. But if you if your property qualifies for certain things, average stay 7 days or less, because you can have Airbnb at whatever amount of days, but like if you're hitting that 7 days or less, the IRS is considered that more commercial transit property.
Mm.
The depreciation rates differ from normal rental properties, but you still get that depreciation, you still get that potential tax loss. But there is a short-term rental strategy where, as a long-term rental holder, um, if your income is over a certain dollar threshold and you can't prove that you're a real estate professional, you may not be able to use those losses in year one. On the short-term rental side, is the bar is a lot lower to hurdle in order to claim those losses, and you're more like because you're more active because of how frequently the property is being turned over is considered a little more active than just having a passive long-term rental. So you could potentially use those losses from your short-term rentals to offset W-2 business income as well as your other real estate income as well.
Does that so can you do that subleasing, or do you need to really own the property?
You have to own. So depreciation is all about who owns the property. So if you're subleasing, you're not going to be able to take advantage of that.
Right. Okay. You talked about, and I'm trying to, I want to bring things that we know about, but the audience might not know about as much or at all. You talked about credits or tax help for real estate professionals. I kind of generalize it like that. Explain, go more into detail about that and like the hours that's needed, in real estate to claim those deductions.
Yeah, so in order to to claim to be a real estate professional, as a real estate professional status, reps is what people are the sexy hot tax topic, if you can call any tax topic sexy. That's the one that comes up quite a bit. But it's 750 hours in a real property trader business. Now, why that's the real property trader business is kind of key is that you can't be like your hours spent if you have a mortgage company. You're not really there's not you're not dealing with the property, you're dealing with the paper. Same thing with me, like even though I'm a tax professional in real estate, like I don't deal with the property, I deal with the taxes associated with it. So if you're a property manager, real estate agent, or actual real estate broker, contractor, like those hours could qualify for that 750. But the caveat people have to remember is that that's half of part one. The other half of part one is that more than half your work time is spent in a real property trader business, and it could be a combination of all those different activities. So, a lot of W-2 employees and non real people running businesses that not related to real estate kind of get tripped up over because easy hit 750 a year. It's difficult to sit here and say that if the average person with a full-time job works 2,018 hours a year, that you turn around and work 2019 in real estate, considering weekends, if you have a
Hmm.
family, is not really credible in the eyes of the IRS from that standpoint. So that's all part one. And then part two of it is material participation in your own or rental real estate. So you can provide contracting, property management services, and get the rep hours, but you need to have your own property to get the material participation, so you can use the losses from those properties to offset your other active income. And a lot of real estate agents have that issue where like they're real estate professionals, they got that box checked, but they don't own any properties. So they don't really like so just being a real estate professional doesn't really mean anything if you don't have rental properties.
Mm. Is there any way to get around that? Say
Well,
no.
the short term, well, the short term rental strategy helps because the properties are transit. Then you don't have to be a real estate professional. You just gotta prove material participation. And there's multiple ways to prove. And like I said, one of them is you worked 100 hours and more than anybody else. Like like working on the property itself. There's like especially if you don't have a property manager, if you're self-managing, or you just have 500 qualifying hours, and so you have that to prove. But like I said, that's more on your short-term rental strategy. I said, but in regarding the long-term rentals, like it's difficult to kind of get around that unless you're what's considered a mom and pop landlord, and your adjusted gross income is $100,000 or less. Then you can write off up to $25,000 of passive losses against your active income, but that starts to phase like every dollar above that 100,000, that 25,000 phases down $2. So by the time you get to 150, you're completely phased out, and you have to qualify real estate professional status. And if you think about that, I mean, the to not do that is around the 70s why the IRS kind of started putting these parameters in place, because we got high net worth individuals, a lot of doctors, physicians that were kind of taking advantage of doing a little bit of research in real estate and then claiming all these losses, but they were really spending most of their time in their profession. So they
Mm.
put the passive loss limitations in place. There have been some amendments along the way to ensure that people who are truly uh, in real estate can truly take advantage of it and not get lumped in with those that are kind of just dipping their toe in it, or not, or can't really hit those qualifying hours and time.
You got to find some kind of way to pay for the jet. um, from a tax professional um, position, how would you recommend people get into real estate investing?
From a tax perspective, I would always recommend people to take the LP role, limited partner role, in any type of investment, whether it was a large syndication or investing or being a lender. So at least even though you're receiving income and you may not be able to use the losses, you're able to get the education while making money and not be taxed as if you were working more in your job and getting additional tax from that perspective. So at least you can start to kind of build that up, and slowly, especially now in October 11th, if you can find a short term rental, like I said, that's really the kind of golden key, because like I said, we're at 100% bonus for 2022. It starts to sunset by 20% year after year starting next year. So even 80% bonus appreciation is rather good. So if you can't find the LP role, or you want to kind of do your own deal, then I do recommend taking the short term rental route, where it's like, okay, you'll get the losses, you'll probably get some hard knock education along the way if you don't want to invest in somebody else's deal, or can't find someone to invest a deal into.
Um, so this is the bonus tax. That was the. I won't get political. Let's flip it. Do you think that they're going to bring back the 100% bonus tax in the upcoming presidential elections?
Well, we'll see, because like I say, it completely phases out in 2026 or 2027. I can't remember the exact one of those 2 years. And what people have to realize, that the goal that the government is trying to always do is to incentivize people to do something.
Mm-hmm.
Either it's incentivize people to buy a home, and they give you a mortgage interest credit, or
Mm-hmm.
incentivize investors to buy more properties, and you give them depreciation from that standpoint. So there's been a lot of buying, and like especially with interest rates going up. Okay, we'll see where how this looks in 2 3 years. We're like, it's going to be brought to the table once we're at that 40 60 40% range. Okay, would they amend it from, or put it back to 50% like it was before 2017?
Mm-hmm.
Because you don't want investors and business owners to stop um, circulating money in the economy, because that would keep the whole thing rolling. And that's always, and I tell people, like, the tax code is made for business owners and investors, Because if it was just as simple as you make this much money, you get taxed, then not too many people are going to really put themselves out there. Like they want some incentives from the government. The governments, and this is around the world, not just the U.S. It's like all types of governments have certain incentives to get investors to build in their countries,
Mm.
um, and to redevelop, build, provide jobs, provide housing, provide food, provide water, and take that risk. And for taking that risk, we have these tax credits and tax deductions that the average person doesn't really get because they're only or there for their W-2.
What what does your average client look like on the real estate side as far as property and net worth and all that?
It ranges. Like I said, we've been transitioning a lot of clients out. A lot of them do. I mean, most of them are like single by them. Like even if they're single by themselves, they're six figures. If they're married, I mean, they're probably close to like half a million in income that they're bringing in. Um, like seven figure net worth from that perspective. They have a side business, and they probably do have a lot of them do have at least 10 doors to their name. That they're whether it's just little projects they built up along the way, or they got into some larger investments. But like I said, we but their strategies are always changing. Like I said, we still pick up a lot of people who are just focused on short-term rentals, which has been hot over the past few years. So we have a lot of clients who are taking advantage of that from there.
What do you think the next new trend is?
With the what was it, the Inflation Reduction Act, even though it was a bit of a joke itself. But there's a lot of energy credits like in there, so probably more and more investing into energy credits or investment opportunities, whether people's in their homes or in their properties, and they can kind of take advantage of it there. Um, a lot of there's always, I mean, unlike '08, I mean, we still have this like shortage of housing, especially affordable housing, and then how people are going to take advantage of low income housing credits or low income housing tax credits from there. So like that will probably be a trend as more and more developers kind of trying to work with the cities on getting grants and also taking advantage of these credits because there's don't really see to me more people going into the opportunity zones that may get revamped because it was enterprise zone before that, and like I said, so that's going to be all reworded in a
Mhm.
way to get more investors to like go into these underserved communities and get those redeveloped. So those probably be the next thing, hot things going as people start to, hey, 100% this year, 80%, and then see what's next up from there.
Is real estate the best tax shelter out there, or are there other industries or niches that outperform real estate?
Real estate is up there because of the pre, like not too many other industries allow for just this paper loss to be claimed over and over again as you continue to buy. Um, Energy and gas, oil, all of that. That's rather popular as well. A lot of sheltering in those in those fields. But those will probably still be the top two from my experience.
Hmm. Man, it seems like we're going on a roller coaster with these interest rates. What's your thoughts? I just feel like we're going back to normal. What do you think, though?
I mean, yeah. I mean, it's for those, and I'm not. I mean, I'm pretty sure a lot of your viewers have kind of seen like, I mean, everybody's saying record lows. Okay, so if this is a record low, um, things have to kind of bounce back into somewhat normal at this point. And those that, I mean, people who have been running their numbers properly, like they still have some space between what their returns are and what the interest rates are going to in order to still benefit. And unlike those who may have been running it thin, um, single digit returns and all of that to just get a deal done. So like I say, it's whether you would call the tide of turning or whatever, but I mean, a lot of people are going to be exposed, and those who with the knowledge in place is going to take advantage of even in the down economy and still find ways to capitalize off of it.
Yeah, I agree because I'm getting deals, and before the deals didn't work because the price was too high. Now the deals don't work because the interest rate is too high and the price is still slightly high because it's all multifamily. So yeah, but like you said, you keep doing the deals and sooner or later you'll find one that work.
Yeah, I mean, and there's going to be an adjustment period for sellers where it's like, okay, at some point, mm, stuff has just been sitting, they can't take it, and like they can't make the payments anymore, and that's where the
Mhm.
whole like pocket deals, wholesale deals, all that starts to kind of come into play there. Where it's like, okay, still probably too early to see that transitioning happening now, but
Yeah.
you can see it happening in the near future.
Yeah, it's gonna probably within